The first quarter GDP number has come in at 13.5%, which is lower than street estimates. They were standing at 15 to 15.5%. They are also lower than the Reserve Bank's projection, which was 16.2. Now, if you adjust this lower Q1 number into the RBI numbers, the RBI's full year forecast arithmetically should fall from 7.2 to 6.7%, and many economists have already brought down their forecasts. But let me give a different interpretation. At the outset, a 13.5% GDP growth over 20% last year Q1 doesn't look all that bad. Let me explain why and what looks weak. The actual Q1 GDP is 36.85 lakh crore, which is only 3.8% higher than the pre-COVID number, of FY20, the first quarter. The weak elements are: one, construction. Construction GDP has come in at 2.62 lakh crore. It's a good 16.8% higher than last year. But if you compare it to the pre-COVID level, then in 3 years, the growth is just 1.1%. Likewise, another huge category, trade, hotels, transport, communication and broadcasting. A large segment, its GDP was 5.59 lakh crore in the latest Q1. It is 26% above last year, but 15% below what it was 3 years ago, that is FY20 Q1. And these are the two sectors that comprise, the small MSME units, your Udupi hotels, traders, unorganized labor. Okay, now what are the strong points? Private final consumption at 22 lakh crore is 26% above last year and a good 10% over the 3-year-ago level. Not bad at all. And capital formation, gross fixed capital formation has come in at 12.8 lakh crore, which is nearly 7% above the 3-year-ago level. Not spectacular, but at least not all that bad. So what more does this Q1 number tell us about the hidden weaknesses and strength of the economy? Is there strength in domestic consumption, which I pointed out, strong enough to improve the coming quarters? Or will the coming quarters be worse off because of the global slowdown? For all these questions, I am joined by an eminent panel: Abhishek Upadhyay of ICICI Securities, primary dealer; Pronab Sen, the former chairman of the Statistics Commission; Samiran Chakraborty, chief economist, Citi India; and Rob Subbaraman, the global economist of Nomura. Gentlemen, thank you very much for your time. Rob, let me start with you. I mean, it's a great year-on-year story because, we had a terrible first quarter of FY21. But this weakness over the 3-year-ago level, is this an Indian phenomenon or are you seeing it everywhere? How do you interpret this number?
Hi, Latha. It's great to be back on your show. I would say it's not just an Indian phenomenon. I'd say it's an emerging market phenomenon. If you're looking at many emerging markets and their levels of GDP now compared to just before the pandemic, some are still not even back to that level. Some are only just marginally above that level. So emerging markets, much more so than developed economies, have really struggled to fully recover from this pandemic. And I'd say India is in that bucket as well.
Okay. All right, I'll come back to you on the global impact, recessionary impact. But Samiran, I got your note, and you also point out that actually domestic demand is very strong. I pointed out to the personal final consumption numbers as well. If that is so strong, should not the domestic consumption engine be able to propel us better in the quarters to come? Why are you reducing your GDP forecast?
So good morning, Latha. Actually, most of our GDP growth forecast revision is simply a arithmetic exercise because the first quarter GDP came in much weaker than what we were expecting. So we had to adjust for it. If you look at our rest of the year forecast, we haven't changed those forecasts in a very big way, at least in a sequential momentum sense. And part of the reason simply is this hope that the pace of domestic growth momentum would continue in the latter part of the year. Obviously, the big hit for the first quarter GDP was the almost minus 600 basis point impact that came from net exports. And to what extent current account deficit moderates in the latter part of the year and this headwind becomes lesser is going to be critical. If we believe that some of these headwinds remain very strong, then even this 6.7% forecast that we have for the full year, there could be downside risk to that number as well.
Oh, okay. Now that opens a new line of thinking. There are a lot of people. We just have Moody's cutting down growth rates of both global economy, emerging markets, India, US, just about every economy. Dr. Sen, I was pointing out to construction and trade, the large sectors which represent the lower part of the economy, doing so terribly. What is your interpretation? Can that hold back overall growth? Or can this strong consumption of the upper part of the economy continue to propel us?
The consumption pattern is skewed, and that can propel us for a while, but it's not sustainable in the medium term. The question is, how long is the medium term that we are talking about? If we are talking about the next couple of quarters, we may still be okay, but I think after that we should start expecting a falling off until and unless we start seeing a very, very strong response in construction and in the trade, hotels and restaurants sector, which, as you said, are very large sectors for employment. But having said that, I think there was a little bit of exuberance in the projections that were made earlier. Okay. If you recall, I've been saying that we should be expecting around 6.5% with a downside risk, and that seems to be coming true. I'm not claiming credit for this. It's bad news, but we really should be cautious about sort of over projecting what the Indian economy is doing, and we haven't yet factored in what is going to be the effects of the tightening of monetary policy.
Yes.
At the moment, it doesn't seem to have had much effect. But sooner or later, it will.
I take your point, sir, and that is going to be my next set of questions. But before that, one more question to you, Abhishek. Any other points from the GDP that we have not yet discussed? And particularly, I wanted your view on, government, whether it can make a difference. Government final consumption expenditure has hardly grown. It's somehow not gelling with the fiscal data we got. It looks like the expenditure is not bad at all. But do you think those are factors that can propel, like construction, capex, whether any of these can give us an upside surprise?
Well, so the main reason for downward surprise compared to our forecast, which was close to RBI, was the industrial sector performance. So manufacturing, mining sector, the growth pickup in those segments was much weaker compared to what you would expect based on data such as IIP. That in turn reflected margin squeeze faced by this sector because of higher commodity prices. Now, the silver lining is that commodity prices have come off of late, and that should then act on the opposite side and support the numbers in the current quarter and perhaps in the second half of the year as well. On the government spending side, yes, center government spend on the capex side has been strong, but on the revex front has been weak. Also, the states spending has started on a relatively soft note. So, but these segments, you would think that government, looking at the current bond yields, for instance, which are so low, government will have some fiscal space to spend because tax collection numbers also looking reasonably robust. So I would think government spending will pick up both on the revex side because a lot of this subsidy spend tends to be back-ended, and on the capex front because states will spend more in the remaining months after a very weak start.
Okay, fair enough. One hopes that can be a propeller. But Rob, I was talking about these global numbers coming in lower, people cutting forecasts for China, for US, and for the global economy. Will this mean that there will be more headwinds for growth, and will Nomura itself look to lower its India GDP forecast?
So absolutely there's going to be headwinds. We're already forecasting recessions in the US Eurozone, UK, Canada, Australia, South Korea, New Zealand. Many economies now we think are going to have negative growth for the whole of 2023. Let's face it, central banks have been very clear now post-Jackson Hole. They're going to get inflation down no matter what. If that means tightening into recession, so be it. We have an energy crisis in Europe and droughts in other parts of the world. We have China really struggling with its zero-COVID strategy and a property crisis as well. There's a lot of headwinds to global growth. We have minus 1% roughly GDP for the US, Europe next year. There's clearly downside risk to our India GDP growth forecast for 2023, which is currently 4.7%. I think this GDP number that just came out for India, I don't want to sugarcoat it. I think that's as best as it gets. I think it's slowing down from here. There was a reopening, pent-up demand that helped. There was a public infrastructure push. But going forward, I think we're heading to a slowdown, and I think many economists will be revising down their growth forecasts as external factors hit. Oh,
okay. That's not looking good. Samiran, let's talk about net exports, taking from what Rob has said. You point out in your note that actually net exports is one of the reasons why we have done badly. I mean, our imports have done hugely well and exports are certainly not keeping pace. Won't that continue? What is your best hunch?
So obviously, in a nominal sense, the current account deficit number is going to be maybe higher in 2Q compared to 1Q. But post that, we are expecting the nominal trade deficit numbers to start moderating a bit. The question is that to what extent the deflator of this would affect the real part in the GDP, and it becomes a bit technical to understand. The other issue is that if India growth is also slowing down to some extent, the import volumes should also come off, and the relatively whether global growth is going to slow down even faster, affecting our export volumes, that is going to be a critical driver. But at this moment, we have been slightly optimistic in forecasting that for the next few quarters, the headwind from this net exports will not be as sharp as it was in the first quarter.
Oh, really? Dr. Sen, what's your guess? Do you think, I mean, the way in which other countries are getting their estimates lowered, will exports be a bigger drag in the second half? Samiran thinks not.
No, I think Rob was fairly clear about it. Yes, of course, it's going to be a drag. The real question is not what's going to happen to exports. I think that's almost entirely predictable. The real question is what's going to happen on the import side. And the thing is that if we are expecting the overall growth rate to be, even if it's slightly sub 7%, what gives us to think that import growth will come off? I mean, other than the pricing of the commodities. The sense that I have is that we have entered a consumption growth pattern which is import intensive. And that's not going to be changing in a hurry. So my worry, as I said, on exports, I'm not worrying because I think that's inevitable, and Rob was very clear about that. But on the import side, I am less sanguine.
Okay, if imports are going to be strong, then there is a current account deficit issue. Then to what extent will the Reserve Bank be forced to continue to hike rates, because the Fed is also hiking rates and the external sector will have to be defended? All those questions to my guests after the break. Welcome back. We have been discussing the first quarter GDP numbers that have come in below market expectations and the general state of the Indian economy in the global context with Rob Subbaraman of Nomura, Pronab Sen, the former chairman of the Statistics Commission, Samiran Chakraborty of Citi, and Abhishek Upadhyay of ICICI Securities Primary Dealership. Gentlemen, thank you for your patience. Abhishek, there is a bit of a nuanced difference of opinion in terms of how serious the current account deficit problem could be. But what is your estimate of the Reserve Bank's rate hiking cycle? The Fed seems to be hawkish. There could be pressure on the CAD. And therefore, what is the rate cycle? Can it impact growth?
Well, I agree. So CAD is a concern. So in percentage of GDP terms, we may be tracking far lower compared to, say, the taper tantrum period. But absolute CAD at more than $100 billion is going to be challenging to fund in the environment that we are talking about. Of course, it is possible that there is a lot of speculation right now on India getting included in international bond indices. That process could start next year. But this story has played out in the past, hasn't worked out well. So we have to watch that space. I do think RBI needs to be mindful of external sector situation to not overestimate how much leeway they have in framing policy here. Also, inflation is reasonably high. So core inflation at 6%, food inflation showing no clear signs of any sharp deceleration should mean that RBI should try and take real policy rates at least towards zero levels by the end of this fiscal year, and perhaps positive next year. So we continue to assume RBI will front load policy tightening. Expect at least 35 basis points rate hike in September, perhaps 50, assuming what Fed does, what ECB does. And at 6% they may pause, but it is likely that there will be some more rate hikes after that also.
Okay, so what's the impact of all that on consumption? I'm coming to that point in a minute, but Samiran, since you spoke about demand, let me scratch that point further. A lot of IT companies are now pulling back their variable pay. Is this urban consumption engine very strong in Q1? Can it continue in the second half?
So, Latha, we just did an analysis of about 3,000 listed companies' wage cost growth data. And what it shows is that while the wage cost growth momentum for IT has slowed down, the non-IT pack, the momentum has improved a little. So what we are hoping for is that while the IT slowdown continues for the next couple of quarters, for rest of the sectors, if this momentum persists for a bit longer, then maybe the overall wage growth momentum is not that badly impacted. So right now, for the first quarter, the overall wage cost growth was 12.7%, which is running much higher than the inflation rate. This is very important because, as we know, rural wage growth momentum has been much weaker at a negative real wage growth. So if urban wage growth momentum also falters, then we would have a significant headwind to consumption. So IT part, yes, there is a decline, but the non-IT, particularly the smaller MSME kind of segments, is where we are seeing some catch up in wage growth, and we hope that continues for the next few quarters.
Okay, but IT is a huge engine of growth. I mean, it's a large employer in India. Dr. Sen, two questions since we're running out of time. One, you refer to the rate hikes. Do you think if things go as high as what Abhishek is saying, 6.25% or thereabouts in terms of interest rates, will that impact consumption so much? After all, this is a country which has seen, 9% and 10% home loan rates forever. So will it really impact consumption so much?
At the moment, no, I don't think so. But, RBI has a bit of a problem on its hands. On one hand, the inflation story demands rate hikes. And given, what's happening in the rest of the world, the rate hikes will have to happen. But the problem that they face is that if they are very aggressive with rate hikes, you could actually see the rupee appreciating against numerous other currencies, which is, again, bad news on the CAD front. Now, balancing that is going to be a trick. And that's what RBI is faced with. So I'm not very sure what they're going to do on this, but it is a problem that they will have to tackle head on.
Okay. Yes, that's true. China actually has been cutting, and India will have to worry about that. But Dr. Sen, anything in these numbers and the past few numbers that worries you about our trend growth? I mean, with a base like that, we should have been 7% and above this year. If we are not managing it this year, subsequent years, will we manage at all?
Yeah, I mean, again, the real question that we need to ask is, where is the weakness? As you said, consumption seems to be coming back fairly strongly, but that consumption seems to get reflected much more in a worsening of the CAD than in the growth.
Okay.
I mean, what we should have wanted is that growth should have been 7.5% and CAD should have been 2.5%.
Fair point. Rob, that's the final question to you. Any comments on India's trend growth? Anything that you're picking up in terms of longer term? Will we get to that coveted 7% or are there some persistent weaknesses?
I'd say two things, Latha. I think Mr. Sen was very right in terms of what India needs for higher trend growth is a lot more investment, not a lot more consumption. I think the risk of higher consumption is a wider current account deficit. So there needs to be more efforts to promote capex and infrastructure spending, soft and hard. That's not going to be easy in an environment where interest rates are going up. The second thing, which I think is a constraint on higher potential growth, is India's fundamentals, which have deteriorated. If you're looking at the fiscal position, if you look at the current account position, if you look at inflation, that makes it harder to have higher trend growth in the medium term. So I think that's another kind of headwind that needs to be resolved. And to be fair to India, India is by no means the only one facing weaker fundamentals. It's a global situation right now.
Okay. Well, I have the final question. Dr. Sen has already said that he was expecting only a 6.5 odd growth for the current year. Samiran's printed number is 6.7%. Rob, will you be lowering the India forecast?
We're looking at it now. We're currently at 7.2 for this calendar year. The risk is we could potentially lower it.
Abhishek?
We are retaining 7.2%, but clear downside risk to that.
Okay. Gentlemen, thank you very much for joining me. There are two people who are looking at sub 7% growth for the current year and two people who have downside risks to their 7.2% growth. That's a slightly pessimistic interpretation of the GDP numbers, but we have to live with it. Thank you very much for watching this edition of Indianomics. More news and updates lined up for you.